How much have you thought, if you have children or perhaps relatives who need some help getting a first home or maybe their second home, have you ever considered putting up money for them, putting money towards a deposit, or perhaps going guarantor on a loan if they aren't eligible for one that of the size that they need? If you have thought of this in the past, maybe if you've done it, you're not alone, because this is a growing trend. Now, it can be argued that it's harder to get a first home these days. I think that's fairly arguable. Maybe it depends on priorities, but there's no doubt that land and house prices have risen, and some might see them putting those prices out of the reach of many young people, and that's why a lot of parents or family members are getting involved. But it's getting to the point where banks are now tailoring loans because of the amount of interest in parents and other relatives helping younger people out. What's it all about? It's been dubbed the Bank of Mum and Dad. To find out a little bit more about it and the pros and cons of this, Marissa Schultz from Rise High Financial Solutions joins us. Hello, Marissa.
Hi, Sonya. Thanks for having me.
Yeah, good to talk with you. The statistics I've read suggest that in the last 12 months in particular, the numbers of people looking into these types of loans has really stepped up.
Absolutely. I think, like you said, it is arguable that it's harder to get into your first home, but definitely what we're seeing is that we're seeing that it's harder for first home buyers to save the initial deposit that they need, and whether that means that they're allocating their savings towards different priorities, it's just that they're struggling to get that initial deposit that gets that foot in the door to be able to buy that property. So we are seeing an increase in the number of parents that are stepping up and helping out their kids so they can get the foot in the market and buy that first property.
And so from your experience, is it people putting and contributing money towards a deposit or going guarantor on a loan that's more prevalent?
Well, there's really three main ways that parents can help their children to get into the property market. One way is obviously that the parents can give children cash, which boosts up their deposit and enables them to buy the property that they want. Mm-hmm. The second way is that they can offer a family guarantee, or they can offer the bank to take security over a property that they own. It could be their family home or an investment property if they've got some equity in it, which just means that the bank is more comfortable lending a higher amount because they've got additional security. Or there is also another innovative way that's sort of coming into the lending market recently, where parents that don't want to have extra mortgages over their properties, but they do have quite a bit of cash. It might be a situation where parents that are retired that have money sitting in term deposit are happy to use that term deposit to secure a portion of the loan to assist the children to borrow more money so that they don't require as much of a deposit. So there's a few different ways that parents can help, and there's pros and cons, I guess, with each option, and it's really dependent on, what situation the parents, what the situation of the parent and the situation of the children, and also what risks the parents are willing to take on.
Yes, indeed. Marissa, we'll go through some of those pros and cons in a moment, but if you're listening to this and you've been in a position to either do this or consider it, I'd love to hear from you. Our phone number is 1300 222 891, or you can text us on 0467 922 891. Marissa, now, one thing I've heard of, and I'm assuming that this has been driven by the increase in numbers of parents wanting to get involved, but cautious about the risk they're exposing themselves to, is that I've heard of these types of guarantees where the parents are only guaranteeing the surplus of which the children can afford, rather than the whole amount. Are you aware of those?
Absolutely, and if you're dealing with a good, reputable mortgage broker, then they'll definitely make sure that that's the sort of product that they select, where the parent's guarantee is very, very limited. So generally the way that these work, and the best way to protect the parents, is that generally the bank will take security over the property that the children are buying as their first security, I guess. And then basically we would work out the shortfall. What is actually missing from the amount that they can borrow, the children can borrow against the property that they're buying, the amount of deposit that the children have, what actually do we need the parent's property for, and then we will only have a very, very small second loan, and the parents would only be guaranteeing that small second loan,
Yes.
and the parents' exposure would be limited to that small amount.
So say you're allowed to borrow
Yeah.
350 or 400,000, and the house you want to buy is 450. The parents may only be guarantor for the $50,000 part of it.
Absolutely.
Yeah.
Generally,
See, that sounds a lot more
guarantee.
attractive than risking,
Yeah.
near on $500,000 with children who
Absolutely.
aren't always as grateful or responsible as you want them to be.
Yeah, that's right. And I mean, I guess it's not, the risks for the parents extend beyond just their children's habits with money. I guess, one risk that parents do need to be aware of is if they are lending to their child, and their child might be in a relationship, and the relationship breaks down, where does that leave the parents in terms of what happens to that property? So there are a few risks that the parents need to sort of think through before they go down this path.
Now, Marissa Schultz is my guest. She's from Rise High Financial Solutions. We're talking about mum and dad banks. Do we know what proportion of the market is seeing parents or perhaps other relatives, maybe grandparents, getting involved in this way?
Look, I think the statistics are about 1 in 4 nationally. I think in South Australia the statistics are a little bit lower, probably because our property prices are that little bit more affordable for first home buyers. So we probably see in, say one in every 8 first home buyers. So it's definitely gaining popularity as time goes on, and it's most probably an area that is going to continue to gain popularity as house prices rise and as young people continue to have different priorities with how they spend versus save their money.
And are banks now recognising this? I mean, this smaller loan guarantee that parents are now entering into seems like a direct result of this increase, specifically tailoring it for parents. Yeah. I mean, are there any options?
Yeah, there are. So I think banks are getting a little bit more innovative with how they approach these scenarios, and they are offering more solutions. We are seeing more banks coming into this space. So, a couple of years ago it was very limited in terms of which banks you could go to for this type of arrangement, but now that we're seeing a few more come into this space. So I think that as time goes on there will be some more innovation in this area. One innovative product that's been released fairly recently is where parents don't in fact give up their property as security, but what they actually do is they actually lend money that they have to the children through the bank. Let me just explain how that works. So if the parents have a fair bit of cash, and generally they would have that cash in shares or term deposit or a managed fund, instead of having that money sitting in those type of investment facilities, they would invest the money with the bank. So let's say they had $50,000 to invest, they would give the money to the bank. The bank would then on-lend that money, the $50,000 that the parents have deposited with the bank, to the child at an interest rate set by the parents. So effectively, the parents are actually lending the money to the children through a lending institution.
But what? And is that trying to increase the responsibility to pay it back that way?
Well, it's trying to increase the responsibility to pay it back. It means that the parents still get a rate of return on their investment. And it protects the parents from. I guess it protects the parents in the case where. It protects the parents in the case of divorce or the children decide not to pay off the loan. It then becomes the bank's responsibility to follow up that money with the children.
Oh, okay. So and what does the bank get out of this?
Well, they charge a management fee.
Okay. Because the banks don't do anything for nothing as far as I know.
Well, that's true. That's very, very true. And that's why I love my job, because as mortgage brokers, we love to try and make sure that, we save the customers as much money as possible. But obviously there's always fees attached. So the bank, I guess what the bank gets out of it is that they get the customer to have the main loan with them. So they get the lending over the, the big chunk of the property. And they also get a small management fee for looking after the arrangement of the parents lending money to the children. So there is something in it and that scenario is not for everyone. There are different, like I said, different scenarios are going to suit different parents. There are, quite a few benefits in it for the child if the parent is in a position to be able to assist them as well. So there are a few risks, but there probably are a few benefits that are obviously the reason why parents do go ahead with this in the first place.
Yeah, well, I imagine the benefits to the children. I imagine the benefits to the children is they either get low or no interest rates usually.
No. Generally, the advantages for the children is that they will save money on fees. So for most children that end up going through a family assistance arrangement with their loan, generally they would have to pay a high level of mortgage insurance if they didn't have the support from their parents. And that could be tens of thousands of dollars in extra bank fees when they initially purchase the property.
Okay.
So often if the parent's in a position to provide them this assistance, then it actually can save, $10, $20, $30, $40,000 in lender's mortgage insurance, depending on the value of the house and depending on what their deposit is. So that's one really big advantage, that the children do have the ability to save a significant amount of money. I guess the other big advantage is that, in many of the instances that we've seen where parents have actually assisted their children with the purchase, the children may not have been able to do it on their own, in the sense that maybe they were looking to buy a $400,000 property and they'd only saved $10,000, which means that for them to save the additional, $30,000 that they would have needed just to be able to get that property, even if they were willing to pay mortgage insurance, might have taken them another 4 to 5 years, whereas the parents are bringing that process forward for them and enabling them to buy a property now, even though they've only saved $10,000.
Yeah.
So I guess they're the two main advantages that, obviously they're mainly advantages for the child, but the parents see that, they would like to help their child in that way, so that's why they do it.
Yeah. Now, Steve raises an interesting point. Marissa, where do the banks sit in these situations with proof of saving? He says, what about the first home buyer's proof of saving if a parent's gift is a portion of a deposit? Because that's one of the elements, isn't it? That you've got to prove that you've got I think it's at least 6-month history of having saved. Is that right?
Look, most banks want to see, especially for a first home buyer, most banks want to see that the borrower has the capacity to make repayments. And the way that they assess that is that they would like to see that the borrower has the capacity to save money, because they figure if the borrower doesn't have the capacity to save money, then how are they going to meet their loan repayments? So the way that they generally do that is different across the banks, but in general they like to see about a 5% genuine savings. Now what that actually means, there's a few ways that we can prove that. One way is that the borrower might just have a lump sum of money sitting in their account for 3 months that they haven't spent. That's one option. Another option is that they've been, constantly saving over a 3-month period, and the bank can see their bank account over a 3-month period and can see that there's been consistent savings there. Another option is for some people that we are able to actually get children a loan where they actually have no savings, if we can show that for the past 12 months they've been renting a property from a property manager.
So that's proof of repayment.
Their rental has been up to date, and that's proof to the bank that, they can actually meet a weekly commitment.
Yeah, right.
And that satisfies their requirement for, making sure that they can afford the loan moving forward. So there's a few different ways we can prove that. Ultimately, the bank's looking for certain behaviours from the borrower, and then they're wanting to make sure that, the borrower is going to be able to meet its obligations. And the bank is even harder on this point when a guarantor is involved, because the last thing the bank wants is the story, a media story where they've had to sell up the guarantor's house. So they are pretty, they do look pretty closely to make sure the borrower can afford the loan that they're giving them.
Marissa, it's been good to talk with you, and for those who do have family members that perhaps need a bit of help or would like a bit of help, it's good to find out what options there are while protecting yourself and your assets and money as well. Thank you for your time.
Thanks, Sonya.
Marissa Schultz from Rise High Financial Solutions, talking about the rise of mum and dad banks. One of our texters isn't too sympathetic, says, I know what I'd be saying. Forget the butler's pantry and the home theatre. Stop getting your nails done and going for overseas holidays and just save. Oh, you're hard. It's 11 minutes to 2 here on 891.